Our next guests say we could be in for a hawkish surprise from Powell tomorrow, speaking of. That poses the biggest risk to the markets right now. Joining me now are Paul Christopher, he's head of global market strategy at Wells Fargo Investment Institute, and Stephanie Roth, chief economist at Wolfe Research. Welcome, guys. You're both,
thank you,
Paul, expecting more than one cut, unlike sort of the median in this survey. Three still? Well, only two in 2024.
Only two
in 2024. Yeah. Okay, two.
Yeah, and two for us as well.
Okay, so Paul, talk through the risks here and how much your probabilities have had to shift as this data has come in.
Yeah, the Fed they'll always tell you that they're watching data, so the risk is to the downside on cuts for this year. But we really believe that inflation will start to resume its downward march, the disinflation. It's just been sticky for a while. That's not unusual for inflation over time. And we think as inflation falls, the economy will slow modestly, and that will give the Fed enough of a window. We think somewhere between 2.5% and 3% inflation, the Fed will cut. And then we'll start to see some of those borrowers who've been constrained by Fed policy, but not by, let's say, availability of other sources of credit, people like consumers, small businesses, regional banks. They will have better access to credit, and that will help really push the economy forward at the end of the year.
And Stephanie, you expect that as we start to get April data over the next few weeks, this narrative is going to shift. What are those key moments you think that'll make the difference?
Yeah, and what we've seen is a lot of the data in Q1 have been subject to a lot of seasonal volatility, and today's ECI is just another example of that. It was seasonally depressed in Q4, seasonally boosted in Q1, and then in Q2 you should start to see a normalization from that perspective. So the first print that we might see will be on Friday, and that's one of the most important April data points that we'll be getting on payrolls. We actually think the payrolls number could come in fairly firm, but on wages, we're looking for a bit of a miss. We're looking for 0.18% versus consensus of 0.3, and that can kind of kick off the start of some of the more dovish surprises. On top of that, the housing data should start to soften a bit as financial conditions have tightened more recently. And then on top of that, when we're getting the CPI prints and the PCE prints starting April and looking forward, they should start to come in a bit cooler. We think that the trend in inflation is somewhere closer to 2.5%. It's been recently held up by seasonal volatility, and that goes the other way starting in April.
Steve, how much relative attention does go to the wage data on Friday and maybe even to revisions?
You know, a little bit less than people think. This morning was the important wage data for the Federal Reserve. Powell has made clear, and I think it makes a lot of sense what he's done, is really shift the focus to the employment cost index, which is sort of an all-in indicator of benefits and wages, as well as being not really corrupted by the constituents of the wages of the employees in there. It's just it's a better way of looking at it, and it was higher than expected. I hope Stephanie's right about the wage data on Friday, and there's a whole lot of other inflation related data we'll be following. The participation rate, are we still getting influxes into the workforce? But I think the unemployment rate is the one to watch. If you want to think about rate cuts this year and multiple rate cuts, I think it may only come with the development of slack in the economy. And that slack in the economy, John, I think is going to mean an economy that runs below potential and one where the unemployment rate is seen rising. Maybe not precipitously, but enough to say, you know what, we're going the other way on unemployment here.
Paul, you like energy, materials, industrials, and healthcare in this market. Spend a little time on healthcare. What in particular is important there? We just had Lilly report. What names are you watching closely to see how it's playing out?
Well, we like all of those sectors that you mentioned. For longer-term investors, our clients are primarily long-term focused, and for the long term, we think the pandemic demonstrated really that the capacity, healthcare capacity in this country, is not where it needs to be for another kind of that event. And so we do look for more public spending, more private spending. Managed care would be a focus for us going forward, less so pharmaceuticals, maybe devices, maybe more neutral there. So that's kind of our way of thinking about healthcare.
Are you looking for upside in particular sectors? Stephanie, or just looking at the market overall in general? We had somebody on CNBC a couple days ago say, don't try to play particular sectors.
Yeah, I mean, we're definitely optimistic on the economy as a whole, which should then lead itself to sort of higher earnings this year. But I'm thinking from a sector perspective, things related to the industrial cycle should do fairly well this year. We're having a bit of a bottoming in the manufacturing PMIs, and we'll see some more details on that tomorrow. But the trend we think is positive. On top of that, you have a decent amount of infrastructure spending. A lot of the public spending starts to roll out this year. And then you're actually getting a bit of a loosening in financial conditions, at least compared to where we were a year ago, and a better optimistic outlook when you're thinking about the chances of recession. So companies are going to be a little bit more interested in doing capital spending, which should support the CapEx side of the economy. So generally speaking, it's some of the more cyclical sectors of the economy that we do like here, at least when we're thinking ahead to the next 6 months or so.